Hello and thank you for joining us today. My name is Wesley Boudreaux, one of the financial advisors here at the Retirement Group. Today we're going to talk about tax planning strategies associated with that retirement transition, going from an employee to a retiree. Before I get started, I just want a quick reminder that everybody, even though we have worked extensively with a lot of your companies over the last 30 years, does not mean we're endorsed by nor employed by that company. However, like I said, we've been working with a lot of them for a long time, so we've got a deep understanding. So if you have any questions, feel free to reach out to us and we can walk you through that transition process as well. A couple things to kind of take note of throughout the course of this webinar. There is going to be a chat box on the screen. So pay attention to that. We'll be putting some information in there periodically, like how to follow along with us on LinkedIn for your company-specific plan updates, where to schedule an appointment with myself or one of the other advisors across America. We'll also maybe put in a survey there, so if you want to let us know how this webinar went or some new topics you want us to cover, just let us know. We'll be happy to take care of that. And there's also a Q&A box on there, so if you do have a question, go ahead and put that in there. Keep in mind your information or your name will be anonymous, so go ahead and put whatever questions you have. We'll be sure to try and get to as many as we can at the end of the webinar. If for some reason we don't get to all of them, we'll actually try and follow up with you on a one-on-one basis and give you that update there as well. Now, a quick reminder for those of you who do not know who the Retirement Group is, we are an independent financial advisory firm that focuses on working with corporate employees and helping them transition into retirement. I mentioned earlier we've been doing this for about 30 years, and there's a lot of specific companies we do work with. The reason we actually work with a select number of companies, it allows our advisors to have a deeper understanding of your specific company plans and really hold your hand through the transition process, whether it be questions on the pension, the 401k, retiree medical, life insurance benefits, all those items we can help you out with. And we'll talk a little bit about that transition in the 401k and pensions, but that's definitely our bread and butter to help you out with questions associated with that. Excuse me. Now, we do have offices throughout the country, so rest assured if you need to sit down with one of us face-to-face, we can still accommodate that. But obviously, this day and age, some of the best ways to communicate is going to be via web meetings, phone call, email, all that's available to you as well. And at the end of the day, if there's anything you take us up on and you haven't done so already, or if it's been over a year and you need an update, is take us up on that complementary cash flow analysis. This is where we can help you determine when is the best day to retire and make sure you're on the right path to meet your retirement goals, whether it be in a couple weeks or a couple years, or maybe you're already retired and want to make sure that you are in good shape. We will not shy away from telling you, hey, you need to work another 2 or 3 years, or you need to work part-time or do something else. But we'll also tell you, looking at the situation, that you might be able to retire sooner than you thought. So we'll go through all those different options and help you weigh the pros and cons, especially as interest rates change and how they affect your pensions, making sure you maximize your benefits from the company as you transition and don't leave any money on the table. So let's get into some of the taxes. We'll talk a little bit about the Secure Act that passed a couple years ago. December 2019 went into effect 2020. We're actually, ironically, at the point where we're going through Secure 2.0. We'll see if this kind of comes through. I'll touch on a couple changes there as well. We'll talk about some of the changes in the tax brackets and in the Biden's proposed tax changes, which were proposed. Looks like they're not going through at this point. We'll still at least address those. So one of the first things that happened with the Secure Act that was a benefit was actually the changing or the pushing out of the RMD, which is the required minimum distribution age, from 70.5 to 72. So that gave you about an extra year and a half of potential tax deferral, which is a great thing. Now, Secure 2.0 is in the works right now. We'll see if it actually comes to fruition, but that's going to push it even farther to age 75. So what that does for us specifically, working with our retirees and our clients, is it gives us more planning strategies or more planning years to help mitigate the risk of that RMD later on in life, where there could be higher tax brackets. So one of the things we do a lot of work with is Roth conversions. So that gives us more years to convert those assets to a tax-free growth versus tax-deferred growth. So again, if you have questions on that, give us a call. We can go through how that can benefit you over the long term. Another not positive benefit, but a negative benefit, and unfortunately I had to deal with this pretty quickly. Like I said before, that was passed in 2019, December, went into effect January 2020. But one of the changes was the elimination of the stretch inherited IRA for non-spousal beneficiaries. Unfortunately, I had a client who passed away mid-January, and this individual who was divorced, so he was leaving the money to his kids, so non-spousal beneficiaries. It used to be under the old plans where they could actually distribute those assets over their life expectancy, so take a little bit out each year. Now the new plan is having to distribute it out over a 10-year period. So the best they can do is take out roughly 1/10 per year. So let's assume you retire, excuse me, or you're retired and you pass away, you and your spouse pass away, and now you're leaving assets to your beneficiaries, which are probably going to be your adult kids, which hopefully are still working and making income. Let's assume $1 million is going to one of them. So the best they could do is take out 1/10 of that roughly, or $100,000 each year, on top of whatever they're making. So that's likely going to kick them up into the next or maybe 2 tax brackets higher. So it definitely becomes a tax time bomb associated with that. So that gets into, again, the tax planning strategies we're going to focus on with our clients, not just for their own benefit, but for their legacy or their estate planning benefits as well. So very important to understand that. If you have questions and you need to review your beneficiaries, let us know on that as well. Another good thing they did was they did away with the age restriction for contributions. So just like they pushed the RMDs out, they actually eliminated the issue where it used to be that once you hit your RMD age at 70.5, you can no longer make contributions to an IRA. That's no longer true. So you can be 80, 85 years old, you can be a greeter at Walmart, you can be working at Home Depot, you can be a barista, doing something. As long as you're making money, you're able to still make contributions to a Roth IRA or a traditional IRA. So that age limit has gone away. So let's go ahead and talk about the tax brackets. This is going to be pretty busy slides. I'm not going to get into too much detail here. We'll give you the 2022 since that's still important for filing taxes, and we'll also give you the 2023 and those adjustments. But as far as the actual tax brackets themselves, those have not changed. It's just a increase in the limits is what's changing from 2022 to 2023. But if we look at the brackets, that first column, you'll see there's different tax brackets, the 10, 12, 22, 24, 32, 30, 35, and 37% tax brackets. So for most individuals we work with, we're going to try and keep them in those lower tax brackets if we can, even if they've got a lot of money. We focus on those different tax strategies. So the first and foremost, the biggest jump or break you would is from that 12% to the 22%. That's a 10% jump. So for a lot of individuals, or actually especially couples, let's zoom in here so you have a better look. If we look at that that third column, which is the second column of the breakdown, you got married individuals, or excuse me, married individuals filing joint returns. If we look at that 12% tax bracket, reading from left to right, that's from $20,550 to $83,550. So once you get over that $83,550, that's where you jump from that 12% to the 22%. Now you've also got the standard deductions, which were raised over the last couple of years, just shy of $26,000 for that married couple. So that 83 and that 26 is putting them well over $100,000 before they have to actually jump into that 22% tax bracket. So let's play out a hypothetical. Let's assume that somebody's retired and they're living well within their means. Maybe they only need $60,000 or $70,000 a year to live off of. So we would have a conversation with them. Okay, you're at, let's say, $70,000, and then so you're at that 12% tax bracket, and we would argue that 12% is a pretty favorable tax bracket, and it may not likely be any lower than that in the future, and probably higher given all the government spending we've been seeing. So for that individual or that couple, let's assume $100,000 to be safe on that top of that 12% tax bracket. We might say, okay, you could take another $30,000 out, pad your savings if you want, or better yet, convert that to a Roth IRA so it starts growing tax-free for the rest of your life or for your beneficiaries' lives, so we can start getting some of that money out of that IRA and reducing the RMD you'll be forced to take out later in life, which at this point we talked about could be is 72 or could be 75 once the Cure 2.0 goes through. So again, this is one of those ways to kind of help mitigate some of the tax planning strategies, mitigate some of the taxes for you and your legacy. But even in some cases, we work with individuals that will do it at the 22 or 24% tax bracket. It just means it's going to be a longer break even to recoup those taxes. But definitely, if you have questions on the Roth conversions, let us know. So like I said, if we look at that bottom, the standard deduction, I'll focus on married couple. I'm not going to go through all of them, but $25,900. The top of that 12% tax bracket, $83,500. Let's go to the next page and looking at 2023. You can see the bump up here. That standard deduction now is $27,700. The top of that 12% is actually $89,450. So you can see those have actually gone up and been indexed for inflation a bit here. The tax brackets have not changed, but the amount that's going to be in those brackets has changed. And then there's also the long-term capital gains rate, which could be either 0%, 15, or 20%, depending upon which tax bracket you're in. Those kind of correlate to once you hit that 12% bracket or higher, you're going to start looking at that 15% level. And again, a lot kind of goes hand in hand if you've got both long-term capital gains and taxable income. If you have questions on this, we can review that with you. And it also factors into taxation on Social Security. So there's a lot of different tax issues associated with being a retiree. One additional issue is where are you living? Who's taxing you? Not just the federal government, but maybe your state as well. Maybe you're lucky enough to live in a state like Texas or Florida or Tennessee or others that don't have any state income tax, or some states that even have state income tax, but they don't tax your retirement. Or maybe they don't tax your Social Security, but maybe only do partial taxation on your retirement distributions. There's a lot of nuances and differences to those, but there are a lot of clients we've worked with that maybe worked in California or New York and decided to retire to a different state with lower or no state income taxes. So we run that cash flow analysis. We want to have that conversation with you. Are you staying in your current state? Are you looking to move elsewhere? So we can run through all those different reviews and show you side by side what it would mean, for instance, to stay in California versus moving to Texas or somewhere else, and how much that could cost you or save you over that long term. So if you are thinking about making a change in retirement of where you live, let us know so we can update those reports for you as well. Let's talk about the Biden changes or proposed changes, kind of what happened throughout the course of the transition, and talk about what could happen moving forward since we kind of got through these midterm elections and what we could see transition into 2024. But first, the current changes, what we saw actually kind of happening, as Trump transitioned and Biden came in, a lot of these were focused on the pandemic and still kind of processing. But we had the Consolidation Appropriations Act of 2021, the American Rescue Plan, those went through. There were some phase outs on deductions and credit adjustments with tax filing for individuals. There were changes to the alternative minimum tax. We haven't had that updated in a long time. That got inflation adjusted or indexed, if you would. There were some changes to distributions. That was really during the CARES Act, where you were allowed to take out up to $100,000 without the 10% penalty. That was only a 2020 situation. It was not extended. Then there was also long-term care premium adjustments, health savings account adjustments, and flexible spending account adjustments. So a lot of those different things. And child tax credits were another issue that was taking place as we were kind of coming out of that pandemic as well. Some of the proposed changes. Now, some of these were obviously on the books at the start of the new administration. We went through also the Build Back Better plan. Then we went through the Inflation Reduction Act, and some of those things have kind of been watered down or changed or eliminated. But let's just still at least go through what they were. One of them was to raise the top tax bracket from that 37 back up to 39.6%, and that was going to be, I think, over income earners over 400,000 or above. That's still potentially something that could play out, but again, at this point is not. We'll have to see as we transition towards 2024. Taxing long-term capital gains as ordinary income. This is one that was going to be specifically just for the high income earners over $1 million. So instead of them paying 20% capital gains, they'd be paying close to 40% capital gains. So again, something that could have generated some wealth. Again, tabled for now. One that was the scariest to me was taxing unrealized gains, because this wouldn't affect just the rich. This would affect everybody. Obviously, the normal intended consequences was to tax unrealized gains in portfolios, especially of the wealthy, so that way they could generate some revenue. The unintended consequence that I'd be afraid of happening would be creating fire sales for people that don't have that much money. So let's run through an example. Unrealized gains are not just in your stock portfolio. It's also going to be in appreciated assets. Like maybe you're collecting art or something like that. Or more importantly, for most of us, it's going to be our property, our house. So let's assume that you've got some parents that maybe bought a house for $200,000 and it grew to $600,000, and they're going to pass that on to you when they passed away. Where it stands right now, that 200 to that 600, that $400,000 of growth is going to get a step up in cost basis. So the cost base of the house when it transfers to you is going to be $600,000. So you pay no taxes on that. If they were to change this, you would actually be forced to pay taxes on that $400,000 of capital gains. Let's assume you're in the 15% capital gains. That's going to be what, $15,000, $30,000, $60,000 of additional taxes you have to pay on that. Now, you may not have that available to pay, so you might have to be forced to sell the the family property, so it creates a fire sale. That's one unintended consequence we need to be aware of. But again, this is still something that has not gone through, but it could potentially be on the table. Other issues as far as extending that 3.8% the health tax through business income, and extending the enhanced child tax credit, that kind of died with the last bill, but again, something that could be revisited. Making the tax changes from the American Rescue Plan permanent, not happening, and some potential changes to healthcare options, and again the tax credits we talked about for children. None of these are going through, but again, it's something that could come back on the table to be aware of at least. So let's talk about some of the IRA tax planning strategies we focus on with individuals we do a lot of work with here at the Retirement Group. When we go through it, one of the first things we want to be concerned about is the effect of inflation. We've seen this rear its ugly head quite a bit in 2022. We were talking about for the last 2 years about inflation around the corner. We knew it would be coming. Now, do we know it's going to be coming this swiftly and this high? No. But what we've seen, obviously, is that sharp increase in inflation, the sharpest increase we've ever seen, closest being back in 1969 or so, when we saw the bond market getting rocked at that point. So this has obviously kind of rocked the bond market over 2022, and the stock market as well. Where inflation's hurt the stock market is more so on the growth in tech firms, because again, a lot of those growth companies, they're fueling their growth by easy money. They were borrowing money, which obviously got more expensive in 2022, so they weren't able to do this as much, and that hit them on the balance sheet. Then on the bond market getting hit as well, because as interest rates rise, it affects bond prices, because what's going to happen is as new bonds come out and they are going to have a higher yield on them, nobody wants to buy your old bond. So let's say if you had bought a bond that was paying 3%, and then all of a sudden now somebody went to go out there and buy a new bond. Let's say I went to buy a bond for the same maturity, it was going to pay me 5%. Well, why would I want your 3% bond? I'm not going to give you that $1,000 par value anymore. I might give you a discount. Maybe I'm going to give you $950 or $980 or something like that for it. So that's what's going to drive down those bond prices. But as we kind of move through this transition and hopefully level off on inflation, we will actually see that level off, and we'll see a rebound because those yields have increased on the bond side as well. As far as the transition process I mentioned before, a lot of the companies we work with have both a 401k plan and a pension plan. Some of those pension plans only give you a single life annuity. Others give you the option to take a lump sum, whether it be a cash balance plan or the ability to convert that single life annuity into a lump sum. And for most of those companies, you can roll those into your 401k plan if you want to, but a lot of people that we see working with us here and clearing through Charles Schwab, is we actually look at rolling those over into an IRA. You can roll just the pension or the 401k, or a combination of the two. And usually if you're over 59.5, that's what we're going to be looking at doing, is rolling those into that Charles Schwab IRA. If you're under 59.5, we'll have a conversation with you about keeping at least something in that 401k plan to take advantage of the age 55 rules. But that transfer from a 401k or a pension into an IRA, there's no tax associated with that. It's not a taxable distribution. It's a transfer from one tax-deferred vehicle to another. So just keep that in mind. There's no tax until you physically take that money out as a withdrawal, and that's where we get into the tax planning strategies we'll talk about in a moment. Another issue that we do a lot of work with our clients with is if they've got some after-tax money in their 401k. Even if they don't have it, there could be a conversation as to whether or not it makes sense to start adding it to that 401k, because it's a good backdoor Roth strategy. Let's face it, if I were to tell you I could give you $10,000 and you could let it grow tax-free or tax-deferred, hopefully you're going to say you want it to grow tax-free, because that means you're done, no more taxes paid on it. That's something we can do with that after-tax money in your 401k. So let's assume maybe you've got a $200,000 balance in your 401k plan, and maybe you've put in, let's say, $20,000 over the years. So if you let that stay in there and continue to make contributions, that $20,000 is going to grow tax-deferred. So all the earnings on it is eventually going to be taxed when you take that out. If you can move that over to a Roth IRA, which is really just a rollover at this point, all the future earnings on it is going to grow tax-free as long as you keep it in there for at least 5 years and you wait till age 59.5, whichever is going to be longer. So again, if you want to look at letting that start growing tax-free, that's one option to do it. If you want to look at increasing your after-tax contributions, paying the taxes now and letting those grow tax-free, that's another option to look at as well. So any question on there, let us know. And every company's a little bit unique and different the way they structure that, so there may be issues where you can only take a percentage of it. But just give us a call and we can walk you through that, and also review whether or not it makes sense to change your contributions from pre-tax to after-tax, or half and half, or 60-40, We can go through all those different choices and options with you. Now, looking at the distribution phase, let's fast forward. You are retired and you're starting to take distributions from your accounts. There's a couple different schools of thought, but what you're going to see if you run a review with us or pretty much any financial advisory firm that uses software, the software is going to assume you want to defer your taxes as long as possible. So they're going to assume that you tap into your taxable accounts, like your brokerage account or your cash or money markets first. Then your tax deferred vehicles like your IRA or 401k, and then your tax exempt like municipal bonds or your Roth IRA. This is the norm, but in reality, that's not the best way to do it. If we run a review for you, we'll probably run it this way initially, but then we'll show you the alternatives where we do split strategies. But at the end of the day, the strategy is going to need to be customized specifically to you, because we need to look at your tax bracket and look at that, how it changes year by year, because your income could change, tax brackets will change with administration changes as well. So it's really important to have a specific tax strategy for each individual. If we look at the conventional wisdom where I mentioned the taxable first, take a look at this chart. What you'll see is if we did that, and let's say somebody had both a brokerage account, an IRA, 401k, and maybe a Roth IRA, in this scenario, they would tap into the brokerage account first, then Social Security will kick in. They'll also tap into their IRA, and then once they deplete that, they'll tap into their Roth IRA. Now, what this does, it means in the beginning years, you're not going to have any taxes whatsoever because you're tapping into your brokerage account. You might have a little bit of long-term capital gains or something, or short-term if you're making trades, but for the bulk of it, you're not paying taxes on it. So what happens is that sounds great, but in reality, if we look back at the standard deduction, being close to $26,000, getting over $27,000 in 2023, you want to at least take out that much from your IRA because that's tax-free money. Then we factor into whether you want to be in that 10%, 12% tax bracket. I would argue try and stay in that 12% at least if you can, because that's a fairly low tax bracket. We also have to factor in how much is that going to tax your Social Security, because Social Security is either taxed, either 0% of it's taxed, 50% of it, or 85% of it, and it all depends upon your income bracket. So those are all things we weigh with you. But in this case, what's going to happen is you're not going to pay any taxes early on. You'll pay higher taxes kind of in the middle part of retirement, and then if you get that point where you just got Roth IRAs, you're not going to pay as much taxes at the end of retirement. Better ways to, again, stretch that out and analyze the taxes year by year. So it may mean that the first couple of years you tap into your IRA, tap into your IRA or 401k on top of tapping into your brokerage account so we can manage those tax brackets. Then Social Security kicks in and you kind of do a combination of these, and maybe you also tap into your Roth IRA because you're trying to manage that tax bracket and stay at the top of where you want to be. But again, this chart's going to show you kind of a flat, same process year over year, but in reality, it's going to change. It's going to go up and down the way we would actually tap into these if we're doing our job and working with you, reviewing those year by year. So again, kind of a quick reminder of that is you want to fill up the lower tax brackets with tax-deferred income. Be aware of Social Security, how that's taxed associated with it. I had a conversation with somebody just last week. We were talking about their Roth conversions and whether or not it made sense to convert, because yes, they were in the 12% tax bracket, but if they did, it was going to kick into a higher Social Security tax, so the effective rate was closer to 20%. So you need to be aware of these and work with an advisory firm that understands that process. And you need to strategically utilize the tax exempt, like I said, the Roth IRA assets, especially later in life, and how to manage those, not just for yourself and managing your own taxes, but also your legacy and your estate plan if you're looking to leave money to your beneficiaries versus charity or something like that. Now, as far as the accessing those funds, there's a couple different ways to do it, whether you're in the 401k or the IRA. But generally speaking, if you take a withdrawal prior to age 59.5, there's not just taxes, but also a 10% penalty. There are some ways around this, whether it's being used for post-secondary education, a first-time home purchase, medical expenses, things like that. There's ways to get around that for a certain limit. Also, I mentioned it earlier in the webinar, if you are retiring from the company at age 55 or later, but you're under 59.5, be wary of any advisor that tells you, hey, roll everything over to us so we can help you manage it. We're going to tell you to keep your 401k where it is, or at least a portion of it, because you can tap into that after age 55 without a 10% penalty. Unlike in the IRA, the only way you can get around that is by doing a 72T, where you have to set up a substantial and equal periodic payment over the course of the next 5 years or until 59.5, whichever is longer. So it can be done, but it's a little bit more of more limitations. And if you're going to work with a firm on that, make sure you do work with the retirement group, because we've done this extensively with individuals. If you make a mistake on that side, you could come back and retroactively be penalized at 10%. So be very careful. And then again, at 59.5, that's where you don't have to worry about the 10% penalty. You don't have to actually take your distribution until 72. Like I said before, with the Secure 2.0, it may be pushed back to age 75. But that gives you a lot of time to have flexibility to take withdrawals when you want to. That's where we're going to work with you year by year between retirement and RMD age to see whether or not it makes sense to do any Roth conversions. In some cases, we may do them a little bit every year, or it may be a big one year, and we may be dormant for a year or two. It all depends upon your situation and where those current tax brackets are at that point. So all this needs to be kind of correlated or tied together with the cash flow analysis. Like I mentioned before, right now about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 10 minutes with us, we can gather some data or update the data we've already gathered. I guess about a week we'll put that plan together for you, get it over to you, and spend some time reviewing it and let you know exactly where you stand. And we can uncover some different tax strategies, uncover when's the right time to retire, and help you maximize your benefits from your company and answer your questions whether or not you can retire now or later, and go through all those and run different scenarios side by side so you have those choices to review. So I know, excuse me, I'm long-winded now. I know we went through a lot of information there, but if you have any questions, feel free to reach out to us directly at 1-800-900-5867. You can also email us at info@theretirementgroup.com. I'm going to leave this screen up here while I tap into some questions we had come through, but if you want to follow us along on LinkedIn or schedule an appointment with myself or one of the other advisors in the offices, you can go and use these QR codes. One again to schedule an appointment with our advisors across America, and one to follow us on the LinkedIn page, either to the Retirement Group's LinkedIn page, or you can get onto your company specific once we give you updates on pension interest rates and different changes to the company plans and things like that. And if you need to speak with somebody immediately, give us a call, because these schedules, when they do that online, I think it actually goes out about a week or so before you can get on there. So let me go and see. We had some questions come through here. Let me kind of cover those at this point. Okay, first one. Do you predict that retirement will be better this time next year, or will interest rates continue to rise? If I could predict that, I could probably be on a beach, just making a couple trades every week or so. But to be honest with you, it can go either way. Chances are we're going to see interest rates continue to rise a little bit here, and then we'll finally kind of level off. It may be here in the first quarter of 2023 or second quarter. So they could be higher than where they are right now. They're definitely, I would not assume they're going to skyrocket like they did last year. We'd be in some dire straits, nor are they going to go back down to where they were during pandemic levels. So we're getting into kind of a new norm where we'll see these kind of kick around at this point where we are. It may come down a little bit over the next couple of years, but I don't see any major changes in the interest rates at this point between this year and next year. And so what will retirement be better or not? That's going to be dependent upon a case-by-case situation, how your pension is affected by these changes, and we can run that cash flow analysis to kind of show you. With the impact of inflationary pressures on my retirement, are there any steps I can take to insulate my portfolio and a lump sum, or is it best to weather the inflation storm? So I just talked about the fact that I don't think interest rates are going to change too much from this point, a little bit up, a little bit down. So with that being said, a lot of that inflationary storm, if you want to call it that, might be behind us. We saw that huge rise in 2022, one of the biggest rises and quickest rise we've ever seen. So you're not going to have as big of an effect on lump sums going forward. What we saw is a lot of lump sums drop because there's an inverse relationship. When interest rates go up, your lump sum is going to drop on your pension plan. If you have questions on that, we've got other webinars, or you can call us and we can go through your situation. So we saw a lot of major drops in lump sums. We may still see some more drops, because even if interest rates stay the same for some of you, as you get older, your lump sum is going to drop just based upon age as well. So we can go through all those different scenarios. But if interest rates go up a little bit more, we'll see some more drops. If interest rates go down, you might see a rebound. But again, it's important to review both the annuity versus lump sum when you're looking at those. So some of the ways that inflation can affect you on the pension side. And then on the 401k, obviously we talked about it affecting both the bond market and the stock market. Hopefully on the bond market that subsided. We'll see on the stock market going forward as well. Where can I choose my elections stocks instead of my company's pre-elected 401k fund? Okay, so this, everybody's different because we're talking to different companies on this call here. But what happens is when you go into your 401k, if you don't make the elections, the company will make an election for you. And most of those 401ks is going to be an age-based strategy where it's going to look at what your age is or your retirement date to figure out what's the appropriate allocation. So the younger you are right now, the more aggressive it's going to be. And as you get closer and closer to retirement, it's going to start getting more and more conservative over time. If you don't want that, you want to actually piecemeal your own portfolio, then you need to go in there and change that. So there's your contributions, which is going to change the amount you're contributing and where it's going, whether it's pre-tax or after-tax. That goes back to that conversation we had about after-tax strategies. Or it could be a Roth 401k if you have that option as well. The elections is where you're going to change where that money goes as far as the investments. So it may be going to that age-based fund. Maybe you want to change that to a diversification of your own selection of different bond funds and stock funds and maybe cash. And then if you want to change what you already have in there, that's where you go to the exchanges usually, or the trades, so you trade that around. So if you have a question on this or need us to walk you through it, let us know. We can also talk about the IRA options outside, because some companies allow you to diversify outside your 401k plan, where you've got a lot more choices with Charles Schwab or other IRAs than what you typically are going to have in your 401k. Okay, I'm investing in stocks through my 401k. In this case, how do I know how much I can take out as money? Okay, so I'm assuming it means how much can you access if you need to. Obviously, the 401k is set up for tax-deferred retirement, so you want to defer that into retirement if you can. So you don't necessarily want to take anything out while you're working, but if you need to, there are potential ways to access it. One would be from a loan. Usually the rule is you can actually withdraw up to 50% of your balance with a cap of $50,000. So if you've got over $100,000, you could access possibly $50,000. If you've got, let's say, $50,000 in your 401k, you could only take out about $25,000. And the loans are based upon the company plan regulations and what interest rates, but you're going to be paying yourself back. Depending upon what you're taking it out for, if it's a home purchase, you might be able to go out as long as 10 years. If it's a general expenses, it may only be 5 years. So again, case by case. Then if you need to tap into for withdrawal, keep in mind if you take a withdrawal prior to age 59.5, it's not just going to be taxed, but also a 10% penalty unless there's some caveats we talked about before. And then a lot of plans don't even let you take withdrawal unless it's a hardship withdrawal. You have to prove that's being used for a hardship. So some companies we work with give you some accessibility to it, and others give you full accessibility to your 401k once you cross 59.5. And that's where we do a lot of beneficial work with our clients and prospects, because once you hit 59.5, if you want to diversify outside of that 401k into an IRA, we can definitely help you weigh the pros and cons of whether you want to do it on your own or work with a retirement group and helping you have much more selection diversity through that IRA. And then let's wrap it up here with one more. What investment funds in a 401k do well in an inflationary environment? So this really kind of piggybacks to what I just talked about in IRA. In a 401k, it's hard to say because all of you are in different plans, and some of them are very, very limited, where they only have 6 or 7 funds. Some might have 15 to 20, some might have 50, and some might have a brokerage link where you have access to more choices in that brokerage link. So it really depends. Some of you, unfortunately, may not have the access to some of the funds you would want to look at to help mitigate inflation. Some of you might be able to do that option 1 rollover and work with a retirement group in helping you structure a portfolio to do that in an IRA. But if you have access to them, a lot of the things we did, leading into last year prior to the surge in inflation, and we're still doing some, but again, things change by period. But some of the things were staying short on the yield curve on the bond side. We tend to always focus on value companies, so focus on companies that are established, have cash on hand, continue to pay dividends, so it softens that blow. So we go back to the growth companies that were borrowing money. These value companies are not borrowing money. Yes, they're down, but they're not down nearly as much as what growth companies are. Maybe you want to increase your commodity exposure. Those are all different things to look at as far as mitigating some of the risk of inflation, looking at Treasury inflation protected securities, real estate investments. There's a lot of different options, but really it depends upon what choices you have in that 401k. You may not have that flexibility. So give us a call and we can show you what you have versus what you could get in an IRA. So with that, I know we kind of went through a lot of material and also went through a lot of questions. So if you still have any more, feel free to call us at 1-800-900-5867. A quick reminder again, as I said before, we've worked extensively with your company probably for the last 30 years. So we've got a great detailed knowledge of your plans, and we can help you through that transition process. But that does not mean we are employed by, nor are we endorsed by your company. But should you have any questions, as detailed as they may be, we can probably take care of them for you. So simply give us a call. And we look forward to talking to you, and we hope everybody has a great day.